How's it going out there? It's February 17th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. It's Thursday, which is interview day, and I'm bringing in someone special, someone I admire so much that she actually works for us. Her name is Genia Turanova, editor of Moneyflow Trader, also Unlimited Income. Those are two newsletters in the Curzio Research brand. Genia, how's it going? How's everything going? I haven't had you on in a couple months.
Yes, so far so good. It's been a crazy year, crazy couple of months, but I think we'll be fine, and we're doing fine.
Well, it's funny because, what a different market it is in just a few months, right? Where inflation is now exploding. It's not transitory anymore. We're seeing the Fed about to aggressively raise rates, and every investment firm, which you track as well as I do, right? Investment firms and sell-side research are, raising that number. It was 3 hikes. Now it's 4. Goldman Sachs raised it to 6 rate hikes. We have geopolitical risks, right, with Russia and Ukraine. So for the first time in a long time, in many years, right, we're seeing stocks really pull back. Some of these names got nailed. We've seen lots of names down 25% plus, but times are different. How do you feel about the marketplace right now? Because, again, last time I had you on, a little more bullish, but wow, what about faced by the Fed, which, we're not used to seeing?
Well, I'm a little bit more careful about the market, and I've always been careful, so that's probably saying a lot. I think this market is much more dangerous than it used to be. It doesn't mean that's going to go down in a tailspin market as a whole, but there are several sectors that will continue to see increased volatility. We're very used to see tech going up. This is the ultimate momentum trade that work from home, related to the work from home idea, to many COVID restrictions. Now we're going to be seeing the other side of this. Higher rates, tighter Fed balance sheet, and most likely we'll have more volatility in the higher price work from home tech names. At the end of it, we'll see several winners and a lot of losers. But overall, that's what the market is. It sorts the winners from the losers.
Yeah. And I want to bring everyone in here who's hearing you for the first time, because you're a former economics professor, right? So you follow this stuff even, much more than I do. I love the economics. I try to make it interesting to everyone because I just find it fascinating. It relates to everything you buy, your neighbors and what they're buying and what you're seeing, and I try to make it fun. What's your thoughts on these rate hikes? I mean, are they priced in? I mean, that's really the debate where the market's kind of holding up, and I'm hearing, companies like Heineken say, this is significant. We've never seen it. We have to have massive price increases, and it's probably going to result in people, almost stop changing their habits of drinking beer, right? So, it's not a joke anymore. It's not transitory. I thought it would kind of, start easing a bit, but we're not seeing it with the latest numbers and supply chain issues. All of a sudden, we were hearing from Ford and GM, and again, this is a direct result of inflation and more demand, not enough supply. I'm just surprised that 6-9 months ago, everyone was saying, hey, it's starting to ease. And now, we have a couple companies that the Under Armour, Tesla, a warning for the first time saying, no, we're going to see supply chain issues. And Intel actually came out and said, we're going to see this in chips through 2023. I mean, I haven't heard that forecast. I thought it was kind of done. Then they were going, okay, mid-2022 through 2023. I mean, where are you on all of this in terms of, is this priced into the markets right now?
I don't believe inflation is priced into the market. It's not bad for companies' financial statements if they can raise prices. If we can handle that, they will continue raising prices and the profits will be okay. So it all depends on whether the consumer, whatever the customers of that company is, the consumer or other businesses, will be able to handle more of price increases. And it looks like we're at the point where it's going to be very hard to do. And companies like the Goodyear just plunged the other day because they said, we are doing well. We are raising prices, but we can't pass everything, all our costs to through the prices or productivity increases.
Mm-hmm.
That's going to be continued long topic through the entire year. We did see inflation. You and I, we did talk about it. We saw it before. We were making fun of the transitory term, but it definitely is not. It's not transitory. It's not going to disappear by itself, and it's definitely not a surprise to anybody who has been watching the market. On the other hand, there are commodities. They're traditionally big winners in the such markets. I don't think we've seen the end of the commodity cycle. So there are places in the market that are clearly underpriced, places that would be finding that balance of price increases, profitability, and revenue growth. And there are still spots that are significantly overvalued.
So I want to get into something you said because you're expecting more volatility. We've seen it in a very, very long time. And I want to bring everyone in here again because I created a product called Moneyflow Trader, which you took over about 2 years ago. And I feel like I threw you completely under the bus where I created this product for retail investors where they have a hard time making money or protecting themselves, which professional investors do. And, it's not easy to do it with understanding options. And I said, listen, this is an easy way to do it. You could buy puts. This is a great newsletter. However, the last 3 years, we saw the market go up 31%, 18%. I think it's 28%, right? Which is insane. All right. So, of course, none of that was working, but this is used as a hedge, right? You want to hedge a small position in your portfolio and, just in case when you have this volatility. But now this newsletter has come into favor. It makes a lot of sense. Take us through the strategy here because I'm getting lots of questions. I tried to tell everyone in November, December, and this is when the Fed, when the Fed came out and said, and Powell was like, look, it's not transitory, right? We're going to have to raise rates. And then, I was pushing this and saying, now's the time for this product. This is why we create this product, right? I know if you've invested, you've taken losses, and I get it, but that means everything over your long positions have done very, very well. So you should be okay. Just hedging a small part of your portfolio with the opportunity that if things really get bad, that small position could result in 30, 40% of your entire portfolio because it'd be big winners. Talk about the product and its strategy because I think out of all the products, every single one that we have or that you'll find out there, this one I think is the most important, most relevant over the next 12 to 18 months, even 2 years for investors. Talk about that strategy and how it favors retail investors and how they can protect their portfolio.
Right. So as we all know, investing is important. You want to be in the market over as long as you can, really, because volatility, sell-offs, price declines let you pick up more shares. But you want to stay in the market, and psychologically, it's probably one of the hardest things to hold on through a decline. And that's pretty much why hedging is needed and why you actually created the service and why I bought the idea and was very happy to run it for all these, months and years, because you want to be able to protect yourself against the unexpected. And the unexpected can happen at any time. COVID, nobody knew it was coming, and the plunge that we experienced in barely a month, from late February to late March, is nothing like we've ever seen. You can buy protection during the plunge. In fact, you probably can, but you will make much less or you will eventually lose. You have to be ready. And that's what hedging is. Being ready for the unexpected. For that, we use a specific device. We favor long-dated puts, which means that you buy a put option, which expires a few months to a year from now, ideally at least 4 to 5 months. And that gives you that cushion to stay with the market and not to be afraid of volatility. If the market action is negative, your put will protect you and will make you money. And at best, the worse the market does, the better your put will be. So again, that's insurance. Think about it as insurance, but the insurance windfall can be really helpful if that in the worst scenario, which with volatility as it is, and the Fed and the balance sheets contraction and the inflation not easing up, and with all the geopolitical worries, you need protection, and that's what their service is designed for.
Now, talk about the difference, because some people might not understand options. And when they say options, they get nervous. But talk about the difference between buying a put and actually shorting, because shorting has gotten so dangerous where some of the greatest short sellers in the world have said that, Citron Research has said, we're not doing this no more because, you have the meme stocks, you have all these people, you could run them up in these big short positions, which forces them to cover, which means they have to buy their position. And these stocks could, we've seen stocks go up, 70, 80, 90% in a couple of weeks, sometimes in a couple of days, and it could really wreck you. This isn't that, right? This is something different. But explain the difference between those two, because I have a feeling that a lot of people who listen to this haven't bought options are probably saying, I don't want to short the market. I can get crushed because you have unlimited risk, right? The stock can go up forever and ever and ever, right? So, and if you're short, you could be in a lot of trouble. But explain the difference in those two if you can.
Of course. Yes. So most people are familiar with shorting. You take a position in the stock you expect to decline, and you wait until that happens. If for that stock decline, you return the shares that you have borrowed, and you pocket the profit. If that stock rallies, though, you might be in trouble. Just like you said about the meme stocks, they rallied thousands of percent, some of them, from almost nothing to hundreds of dollars. And any short position would really be killing anybody. That's more than 100% losses, and that's horrible. You can be wiped out with just one short position like this. So the idea for shorting is that you can potentially lose much more than you've invested. Options are different. It's a totally different animal. It allows you to take a similar stand. You expect the stock to fall, that specific stock. You have the ability to buy a put option, and stock rallies. Everything you can lose, the maximum you can lose is your investment. That put will expire worthless. You spend just hypothetically $1,000. That's your maximum risk. Your reward can be substantial because it's a leveraged position, and smaller declines, thanks to the power of leverage, can bring you a much higher gain than the shorting. There's one negative with puts that they do expire. So you have to understand that there will be a time expiration. Every single put trade comes with the time expiration, which is the expiration date of your put. Literally, that's why you buy it. You buy XXX put for the January 2023 expiration. That's on the third Friday of January 2023. That put will cease to exist. If your position is profitable for you, you can close it in cash, took the profits off the table, or you can close it in some other way. But most importantly, if your position is out of the money, your put will expire worthless. That characteristic of any put option you have to be aware of. So there are risks specific to this, but there are advantages as well. And in our opinion, the advantages way overweight the risks.
No, makes sense. And what I love about you is you came to me too, where you're like, yeah, I just don't want this strategy, right? It's mostly this strategy. But you also said, listen, there's some opportunities I'm seeing that I want to buy calls on that are great opportunities. And, while it's been a bull market, you saw what could happen with this portfolio during COVID, right? Where you had a bunch of, triple digit winners in a matter of weeks and months, right? And that's the power of the strategy. But also you did make money on certain calls, and you'll take long positions as well as certain things that you like, where you've been all over energy. I think you made great profits on betting silver twice. Talk about that part as well, because you do like going along some positions. I mean, most of the strategy is that, but also, you're an analyst and you see all things. And from my perspective, doing this for such a long time, I always want to unleash talent where I don't want to put handcuffs on everyone. Where if there's a way that you can make money, I don't want you to be like, nope, there's the only way you could do it. It's like having a gold newsletter and saying you can only recommend gold. Well, we had a good 6-7 year period where gold did nothing, right? So, now you're stuck in this thing where you can say, hey, there's other precious metals, or maybe we're getting into oil, or maybe we're getting into different things. You want to provide that value, and you did for your investors. But talk about that as well, because you do go along some positions as well.
Absolutely. So there are two types of options. The put options we just discussed. You benefit, generally speaking, when their position you bet against declines. Call option gives you the right to buy a stock at a predetermined price. So if you want to buy a stock, that's really a bullish trade. So if you expect, say the market to appreciate, to go up over the next few months, because we've just been through a crazy period of volatility, you might want to buy a call option on the market. If you see energy or silver being crushed, but potentially benefiting from the inflation that we're having or about to have, you might want to take a long position. For that, a call option is the ideal ideal strategy, one of the best leverage trade that you can have. Again, same disclaimers apply. There's volatility involved, and there's always an expiration. Every option will have an expiration. We want to account for this. We want to make sure that we don't get stuck with an option through expiration, but sometimes we do, because the markets move very fast. Like with call option, again, all you can lose is your investment. You can't lose any more than that. That's, again, the beauty of it, in my opinion.
Okay, now for the fun part. You love to share ideas. What are some of your ideas? One of them that you shared, which I love, which is controversial, is ARK. Right. So you talk about Cathie Wood, and, we were talking just before this, you were saying, what do you think about that? Because, you think that there's a lot of risk in that. Talk about, that position or anything else, or throw out a few ideas that you like, even on the short or the long side.
Okay. On the short side, I think there's more risk than the potential reward at this level with this market, with the ARK innovation. So there's a brand new ETF. It's literally been out for less than 6 months, and it's called Total Capital Short Innovation ETF, and the symbol SARK. That's a great way of playing against the high PE and volatile stocks that Cathie Wood tends to like, without applying leverage or without shorting them. Really, they do it for you, of course. So if Cathie's fund goes bananas and appreciate 1,000%, SARK will decline significantly. Mm-hmm. But it's a great play, I think, a relatively low risk play against high PE stocks.
And we're seeing a lot of those get nailed. Right? I mean, even on the Roblox side is a name that I like, but you see a company that's still growing. But at this level, with inflation this high, with the Fed looking to raise rates, I feel like these companies don't have any leeway to miss anymore. And even if they miss a little bit, they get destroyed. Where you're like, okay, next quarter's not going to be good. Forget it. Now it used to be like, oh, well, we're going to be good next year, the year after, you're going to see massive growth. But now in this type of market, I mean, you're seeing a lot of these growth names who are not putting up those normal growth numbers and just miss them by a little bit. You'll see these things really get nailed 20, plus, and some of them are down, but yet, I definitely agree that they're still super expensive in a market where you're taking leverage out of it. So, not as interesting. What about ideas on maybe the long side? And I know you've been, you've liked energy for a while, but I don't know if you want to give it energy a pick, but, what are some of the things that you like on the long side here? Because, look, it is a tough market, and I know that you're not predicting an absolute crash, but there is sectors that are very overvalued here. And, in the market going forward, there's going to be clear winners and losers. Not everything like we're used to seeing, right, Genia, is going to go up at the same time, where we're seeing separation, right? Like FANG names, right? I mean, look at what happened to Netflix, look what happened to Facebook. And on the opposite side, you saw Amazon report great numbers, and that went up a lot. You saw Microsoft and Apple report great numbers. So even separation among those names, which usually always move in tandem, and that's the kind of market I think we're going to expect going forward. But what are some of the long positions that maybe, or sectors that you like here?
Well, I did mention that commodities are usually benefit from inflation. Again, that's kind of given that their hard assets tend to keep their value, but that's pretty much what you can expect from owning a commodity. Oil is a very special commodity because we had a historic demand destruction during COVID. Before that, we had historic price destruction because of our oversupply. That this market was crushed by many factors that came in a row, including green energy. And now it's coming back because of historic underinvestment in the market. There's a saying that the cure for low oil is low oil. The cure for high oil is high oil. We're now having a cure. We've had a cure for low oil because nobody invested. Big integrated companies didn't invest. Mm-hmm. Shale companies went out of business because of the low prices, which they themselves caused. But again, that's the supply and demand relationship in the oil market. It's very unique to this specific area. This said, there's a unique sector within the oil sector that got absolutely destroyed with the years and maybe decade of underinvestment. That's the oil service companies that you can invest in separately, or the easiest way probably is to get the oil service companies through a couple of ETFs. I like the OIH or the VanEck oil service company specific. You'll get the Schlumberger, you'll get the Halliburton. In fact, those two will probably be like 60% of the entire ETF, but it's still diversified. Of course, you might say, yeah, that's a crazy chart. You might say that it's outperformed the market. It's done so well over the past year. Why would we buy it? But click on the 3-year or 5-year chart.
Yep, go 5 exactly. Years, right?
Yep, that's way under the 3-year. I think it's down about 30% over the past 3 years. Mm-hmm. So you want value. This may not look like a traditional value on a PE basis, but that's value in the sense that the market has underbid this for so long that any potential growth improvement is totally not reflected even in that current price. And there is growth improvement because we're finally seeing more and more investment in oil production, oil wells, new capital spending from the big integrated companies. That goes into Schlumberger's, Halliburton's, Baker Hughes, National Oil Well, Varco. These companies will benefit and will continue to benefit for probably longer than even the large integrated oil. Yeah. Integrated are safe, but this is where the excitement is, where the action will be.
Yeah, the excitement and growth. And it is amazing, too. I'm glad we brought up those charts when you look. And you can see that on YouTube if you're watching. If not, get explained to you. Most people listen to this through iTunes. But you're looking at a chart where you see some of these companies up tremendously, especially off the COVID lows. And even though your charts look, you're like, holy cow, I missed it. But when you put up like a 3-year chart, you see these things are still trading 30, 40% below. Yet oil prices are probably higher, if I have to guess, than 3 years ago. Not only that, these companies, came close to going bankrupt. People don't realize how leveraged oil companies were. And, during COVID, and then everything stops and no demand, you're seeing they're being forced to cut costs dramatically. So now you have, these great companies cutting costs a ton, and now you're seeing demand come back. These stocks should be trading well above those 3-year highs, in my opinion. But again, it's hard when you're looking at a 1-year chart and saying, man, these things are up 500% or 300%. They're still down 30-40%, like it just shows, the Halliburtons and the Schlumbergers and a lot of these service companies. So it makes a lot of sense.
There will be pullbacks. Should be pullbacks. Nothing goes up in a straight line, but there's value. Maybe even some dividends too. They used to pay much more, but now they're getting more business, more free cash, and they will be raising their dividends as well. The survivors are the strongest. There definitely were some that went bankrupt, like Diamond Offshore. Deepwater drilling was completely decimated, and maybe for a good reason. But conventional oil is going to see a lot of investment.
No, it makes a lot of sense.
And that's where you play.
Genia, we covered so much, and I just want to say, I love having you on the team. You're an amazing analyst. I respect you a lot. I love your work. I love the patience because, like I said, I feel like I threw you under the bus when I pitched this newsletter to you, and you were like, yeah, and we didn't think the markets would go up so much, and the government would spend trillions and trillions of dollars to inflate this market and keep inflating it even when things got better. But I think right now is a perfect time. We are seeing a lot of people inquire about and ask for it, and I hope they do, because this is something that I think everybody needs to really protect themselves in a market that's going to be extremely volatile. So thank you so much for coming on. I really appreciate it. And I know you join us again soon.
Thank you very much. I had fun. Thank you.
All right. Take care. Guys, this is one of my favorite newsletters because it helps you make money and hedge your portfolio during extreme volatile times, which I feel a lot of retail investors do not know how to do and have not done, and professional investors do this all the time. So Genia has a whole training center on a site. She explains how to buy puts. It's written at a very easy level, which we like to do here. We like to write things very, very easily. This way you understand. She was explaining options. If you understand options, you're probably like, all right, we get it. We know what a call is and a put. But, we want to make sure that we're bringing in our whole audience here because, that's what we do. We want to explain it thoroughly, and people who know about options could have 1 minute of patience while we explain it. But again, a lot of people need to learn this stuff. And from investors that I talk to, and average investors, and I have a pretty good, finger on the pulse here, we're getting over 200,000 downloads now for a podcast. Lots of people asking questions. This is important. This is the reason why I created this newsletter. And creating it and having the right person on this, where she's incredibly smart, which every one of our subscribers sees through her updates, her research, her newsletter. But she has close to 20 years experience analyzing companies. She's managed money, chief investment analyst before. She's a CFA charter holder, which, man, that is extremely, extremely hard to get. And she's also an economics professor. And I love the confidence she has because when she first started coming on, it was like, all right, now she's like, yeah, I'm definitely coming on. And she enjoys it now, right? And, which is cool. But having the right person on this product was important. And like I mentioned, this newsletter didn't perform well the past 2 years since she's been editor outside of COVID. When COVID crashed, I think she allowed like 7 triple-digit winners, including one that went up 500% that she closed out of. But you're looking at a screaming bull market, right? 31%, 18%, 28%. It went up in the past 3 years. And I'm okay with losing those positions. That's fine because you're risking a small part of your portfolio, which is, say, 5%. And I want to talk about that really quick because putting it in perspective, that 5%, if you lose that 5%, the long position in your portfolios are easy going to cover that, right? Or most likely going to cover that. But when the market or certain stocks get nailed, here's the math behind it. Say if you have a $100,000 portfolio and you're hedging 5%, so $5,000. Just say hypothetically. Not that everybody has a $100,000 portfolio. It could be $5,000, $10,000. But say using $5,000. If you're right on some of these names and you get a name like Facebook that declines 25% a day, again, you have 5 months, 9 months, a year, right? These are long-dated puts. That $5,000 could easily turn into $20,000, $30,000, $50,000, which is 50% of your entire portfolio in a market where a lot of these things are getting nailed. So you're basically betting, are you going to see a 15%, 10-15% decline in these names over the next 12 months? I would take that bet right now. I mean, I would definitely take that bet. The geopolitical risk, the Fed raising rates like crazy, they're behind the curve. I mean, there's just so many risks out there right now. A lot of stocks are still expensive, still a lot of leverage in the markets. Again, that fundamental change where you're seeing that punch bowl being removed, it's pretty crazy. Plus, we're coming off, 3 years where the combined gains for S&P 500 was 70%, right? 70%. Well, historically, it's usually 24%. That's a massive disconnect. And it made sense for stocks to go up. Again, we had this big punch bowl of Fed throwing trillions out like nothing. Now it's being taken away, and you're seeing an adjustment. So, to the point here, say if the market tanks 20%, your long positions fall 20%. So that 100,000 goes into 80,000, right? But if you bought long dated puts and say you use 5,000 of that, okay, so really you would start 95,000, but say if you used 5,000 of that grew to $30,000, which could easily happen if you see the market fall 20% and Genia has the right trades on. Now your portfolio is up when the market just crashed 20%. I need you to think about this. This is extremely important. I don't want to bog you down with numbers and just, this is important. So now your portfolio is actually up when the market's down 20%. Why is that a big deal? Because when the market's down, that's when you want to buy the shit out of stocks. That's how you make the most money. And that's why we're sitting on tons of winners in our portfolio that are up 100% or more, because we were able to buy a lot of these stocks mid-2020. I didn't think the market would crash that quick, but we got out of a lot of positions in our portfolio and said, look, this is crazy and China's closing and the market can really come down. And a lot of us, if you listen, we're sitting on good cash balances and good positions to buy the market when it's down. And I can't tell you how many winners that we have in a portfolio, but we actually have a 16x winner. We bought Avis. It went from 50 to, I think, 10, 11, and went back up to 20. And this is in May 2020, right after, COVID crash, and now some of the stocks coming back. We bought at 21. We sold half of it when it went to $357. And that's how you make life-changing gains, not by buying stuff in SPACs that come out all time. They're coming out these crazy valuations, and maybe you can get a nice gain on it. I mean, Facebook came out at what, 50 something, and it's 200. It's 200 now. Maybe you sold at 300, whatever. But 16x gains. You get those gains when the market crashes. When the market crashes, what happens? Most people get their ass kicked. And they're sitting there going, holy shit, I got to sell. Or they're on margin, getting margin calls and going, oh my God. When the good investors who hedge themselves are being like, this is the buying opportunity of a lifetime. I mean, look at oil. I talked to Cactus. Cactus does this every single time. It's the most cyclical market ever. It crashes and it surges. It crashes and it surges. And he's learned because he's seen his friends get wrecked, and he's got wrecked in the past, and he's been doing this for 40 years. Again, he's one of the smartest guys in the oil industry. He's a wildcatter. He's been doing it, again, for decades and decades. He goes all in when he sees the market crash. And that's how he makes his fortune. That's why he's made so much money. And I think he sold one of his wells, which he was partners in, and had several partners for over $1 billion. So that's how professionals invest. They don't go all in. It's win and lose, where, maybe you do that for your hedge fund using everyone else's money. You don't care about it, and none of your money's invested in the fund. I'm not talking about that. But you get the point. When the market does come down, it's this volatile. The people who are in a position of strength, it's like the housing market crashing. If you're sitting on money, man, we could have bought, where I live, beachfront properties are here. They were going for about $350,000, $400,000 that are probably $2 million houses. Even more than that now, that you had the chance to buy. And I'm talking about 2010 when we got here, every house was for sale on a beach because you had all these guys who were speculating, didn't have to put any money down. Nobody wanted houses. That's the time to buy. And you get that chance by protecting yourself, by hedging yourself. And that's why I pushed this newsletter. My fault, I pushed it a little too early, but I also pushed it in November and December, and not too many people signed up or inquired about it. And I said, look, the Fed just said they're going to go crazy and raise rates, stop buying bonds. You're going to take a lot of leverage out of this market, and this market is more expensive than it's been in a very long time. And now we're starting to get more and more requests. So what I'm going to do for you guys, I lowered the price 40% for 1 year subscription, 70% off for 2 years. Why would I lower the price for? Because I truly believe if you follow this strategy, if you follow Genia, who's an expert at this, over the next 12 to 24 months, and she teaches you how to make money during extreme volatile times when people are saying, holy shit, my portfolio's down 20, 30%, and you're like, well, mine's up 10, 15%, and now you're able to buy so many of these positions that you thought about buying that are now 20, 30% lower. If you're able to do that, you're going to be a subscriber for life to Curzio Research, because we're educating you and teaching you how to make money, not just when the markets go up, which anyone could do, right? A kid could do. We've seen all these YouTube channels I see with 3-4 million subscribers, and these guys are talking about, just buy this meme stock. What do they do? I don't know. And then, they don't even have a portfolio. They don't know what's going on. But again, everything's going up, so you're a genius, right? But you're going to, especially in this market where there's so much bullshit and so much fake garbage out there, and people looking to make money so quick with SPACs, even investment newsletter business, everybody's a guru and all this shit, and even though you can't find information about them, you know what? to me, starting this company at Curzio Research is if you're providing great advice, honest advice. I'm not going to be right all the time. Got to be right more time than wrong. I say that a lot. But if you're really helping investors along the way, you're going to be subscribers. There's a reason why a lot of my subscribers have followed me for over 20 years, even from the street.com days. I've been with street.com and, this newsletter and that news, stocks under 10, and then Stansberry, and then Weiss, and then here. I feel bad. I wish it was one place, but now it is one place because my name's on the freaking door. So I'm here. I'm here for you guys. Questions, comments, frankcurzioresearch.com. If you want to take advantage of that special price, you can do so by going to our website, curzioresearch.com. Put your email in a little box right there. You're probably on our email list already. You saw the offer. It's only going to be available through this week. Again, that offer is only to you. We're not sending that out to anybody else. It's a special offer for Moneyflow Trader with Genia. And the only way you can subscribe, the only way you're going to see it is if you're a follower of Curzio Research. So if you want information, you could email me, frankcurzioresearch.com. All I'm doing is urging you. If you don't take advantage of this or whatever, that's fine. Again, I'm trying to help you guys out. But learn how to hedge yourself. It sounds boring. It sounds shitty. I know everybody wants to, buy something and just explode higher and go all in. Genia hit the nail on the head. That's why I love her. She said, you always want to be in this market because if you pull up a trend, the S&P 500, it's the greatest secular trend you'll ever seen since 1950. It goes like this. If you, put it 10 years, you're going to see the COVID, you're going to see, the credit crisis, you'll see the 87 crash, the 2000. But if you look over, it just goes up and up and up. And the people who have been in the market all this time, 60s, 70s, 80s, the icons, the Buffetts, you see how incredibly wealthy they are. It's the people that try to make money with no hedging in place, just all in, no risk. Those are the people that get smoked and they disappear and they get nailed. You want to be in this market long term. That's why you need to learn this strategy. So even if you don't take us up on an offer or Moneyflow Trader or whatever, you can find free information on our site, but learn about protecting yourself. You can do that. The easiest way to do it is to buy puts. You don't want to go short. And I want to thank Jenny for coming on. That was really, really cool. So again, if you want to take advantage of that offer, you can go to our website, curzioresearch.com. You could email me, frank@curzioresearch.com, and I'll point you in the right direction. Or if you're on our email list, you're going to see that offer. You probably saw it already. We're going to do it. That special offer is going to be available through this week. So, guys, that's it for me. I will be doing Frankly Speaking tomorrow, which only goes out to paid subscribers, no matter what newsletter, even if it's Dollar Stock Club, which is $4 a month. You get that special podcast, which is not on iTunes. It goes directly to you. Other than that, hopefully you guys enjoy the weekend. Great time. And I'll see you guys next week. Thanks so much for listening. Take care.